Hello and welcome to The Rate Stuff, your essential guide to all things mortgage. I'm Jack Izzard.
And I'm Peter Stimson.
Rate time, rate place. Yes, we are on the verge, we think, of the Bank of England's third base rate cut of the year.
And we have some good news on mortgage numbers.
Peter, are you feeling all right? Good news. I don't think I've ever heard you say that phrase ever.
I think that's a little bit unfair.
Well, let's see if Peter's ill or he's dreaming. And of course, da, 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 that's my, it's not really a drum roll, it's more like a sort of a trumpet blast, but drum roll, the mortgage guarantee scheme is here. And Peter, should we be rejoicing? Is it the saviour of first-time buyers?
Well, I think you probably need to rearrange the following sentence. Door, horse, bolted.
Okay, so no.
No, I think it's a little bit too little too late, to be honest with you.
Okay, stay with us as we unpack how good the mortgage guarantee scheme really is and if the bank is going to cut the base rate next week. Okay, so let's start with the good news because these are the words that Peter uttered today and that's a bit of a first. So let's roll with the good stuff. So the Bank of England says that the mortgage market is relatively healthy. It issued some data which showed that remortgage approvals in June rose to their highest level since October 22. And also we've seen the effective interest rate, so the interest rate charged on newly written mortgages, fall for 4 months in a row. So some positive signs of movement in the mortgage market, Peter. And of course, we could see the base rate come down next week as well.
We could do, and I think also within that data, you missed off that the purchase numbers were also holding up. You've got to remember that in June, we also saw, data we've seen on house prices actually fell. So against that backdrop, you were kind of expecting that if house prices were falling, maybe transaction numbers are also falling as well. It doesn't look like that from the data we're seeing. So the housing market is holding up, it's holding steady. You've got large numbers of properties coming onto the market. Yeah. So if you're a buyer out there, you've got the highest number of properties out there since 2015. So there's an awful lot of stuff to buy.
Well, it's a buyer's market.
Exactly.
Loads of supply. We're seeing prices come down in some areas. I mean,
Yep.
The official land reg data shows that average prices in London fell over 1% in the
Yes.
last 12 months. Mortgage interest rates coming down as that Bank of England data shows.
Yep.
So happy days, right?
Exactly, and you've got it for first-time buyers in particular. You've got an increase in affordability as well. So better affordability, more choice of properties to buy, and generally lower interest rates as well.
Well, if you cast your mind back to April, people were saying we really have kind of got a fallow period coming because we had that mad busy run up to the end of March because of that stamp duty discount effectively coming to an end at the end of March. But we haven't stumbled. It is ticking over quite nicely.
It is. So, there's always this danger that you get a little bit of a cliff edge after, stamp duty change. We saw that when, we had Rishi, the stamp duty period back in 2020, where you got the sort of the falling off the cliff and the price rises followed by falling off the cliff. We're not seeing it this time. It's carrying on. Prices are subdued, which is causing a bit of a problem if you're a house builder. So obviously house builders want prices to sort of be steady or going up because obviously their costs are increasing in terms of materials, labour costs. So that's causing some challenges for new house builders in terms of bringing new supply to the market. So it would be good if there was a new Help to Buy scheme, to give some support to them so they knew they kind of had a ready market already out for some of the supply. But other than that, if you're a first-time buyer or a second-time buyer, the market seems to be functioning, relatively well at the moment.
And those are the buyers who are most sort of elastic, if you like, in terms of their demand, because obviously that Bank of England data showed a big jump in remortgage approvals. Now, remortgagers kind of don't have a choice because it's either go onto an SVR or remortgage. So obviously, yes, good news that they're remortgaging, but it's the first-time buyers who are always seen as key to the property market. And it seems to be, from what you're saying, that falling interest rates on mortgages are encouraging more of them to get off the fence and decide that now is the time to buy.
Yeah. I mean, a lot of these guys have been renting for an awful long time. Renting, as we've seen, we've all seen the data about how expensive it is to rent. Rental prices have been, going up ridiculously since the COVID period. So a lot of these people are now deciding that, there's been more supply coming onto the market. We've had rising wages for the last, 3 or 4 years, particularly with where inflation's gone. House prices have stayed relatively static over the last 3 or 4 years. They're deciding it's a good time to buy, particularly with interest rates falling.
Okay, Peter, I'm not dreaming. You said the word good about 5 times.
I have. Yep. I mean, if you're a first-time buyer, 2025 is looking pretty good.
Okay, right. Well, let's look into the second half of 2025
Yes.
now. Bank of England base rate decision in early August.
Yes.
Pretty much odds on for another cut. This would be the third cut this year, down to 4% potentially. Do you see any wrinkles in that, or is it nailed on?
So I think my head is saying it's going to be a cut. My only concern is there's a few hawks on the Bank of England committee. Inflation is still high. Food prices particularly are very high and expensive. I saw something the other day which showed you that the price of things like chicken has almost doubled in the last 12 months.
Yeah. My Nando's bill gone through the roof, Peter.
Your what, sorry?
Nando's bill.
No, exactly. So part of me thinks that there is a small outside chance they don't cut, but I think they probably will.
By the way, other chicken shops are available.
Yeah, exactly. KFC, etc., etc.
Okay, so it sounds like we're pretty much on for a rate cut in August.
Yes.
The big question that we always like to ask you is, base rate's one thing, but what about the linkage to mortgage rates? Are we going to see?
It's priced in.
Okay.
So I mean, the only thing.
So this good news is a bit of an illusion.
Well,
we're not going to see.
Well, it's good. It's good news. It's good news in one way because obviously that will get pushed across into most lenders' stress rates.
Yeah.
So obviously, how affordability is calculated is generally based on the reversionary margin plus a stress. So the reversionary margin is SVR. SVRs are linked to Bank of England base rate in most cases. Bank of England base rate gets cut by a quarter. It will mean the stress rates for most lenders will get reduced by a quarter. There is a cap on some lenders' stress rates down to a certain level, but where we are at the moment, it will mean generally most lenders will pass that on in terms of a pickup in affordability. So it will mean that for most borrowers, there will be a small pickup in the amount that a lender will lend to them.
But in terms of the rates that they offer,
in terms of the rates they offer, it's already baked into the swap curve. The only thing that might change is the voting pattern. If there is for example, a 9-0, I don't think it will be, but if it's a 9-0 in favour of everybody cutting rates, and the minutes come out saying the Bank of England is indicating that it's going to cut further and faster, that will push across to the markets, and the curve will change. If it's a 5-4 and the minutes come out indicating that it's going to be a very slow as you go and maybe only one further cut, that will probably push the swaps the other way. So it's all going to be depending on what the minutes come out like and the voting pattern.
This is where we get super nerdy and we ask ourselves, is it a dovish cut or a hawkish cut?
Yes, yeah, exactly. What's the voting look like and what is the general sense of direction thereafter? So my sense is, if we get a cut, it's going to be fairly close. I think it could be a 5-4 or a 6-3.
Okay,
that's my personal view.
Go back to your starting point. So probably a cut in August down to 4% base rate. Another one by Christmas?
Possibly. It depends, I think, very much on inflation and where the economy goes from here. We did have some good news from the IMF. IMF was actually quite positive. I think we were fourth.
We are third.
Oh,
in the
third.
G7.
Sorry, got that slightly wrong.
By the way, this is a pretty low bar. So the IMF upgraded its global growth forecast to 3% for the year. So not as bad as it had said just a few months ago.
Yep.
The tariffs threat seems to have subsided a bit. Britain, we are third in the G7.
Behind Canada and the USA.
Yes, but it's only because people lower down the table like Germany have got absolute stagnant growth at the moment. So we're flattered a little bit by the competition.
Yeah. Okay. Well, that's good news in some sense.
Yeah.
So it's a relative positivity. So it really depends on where inflation peaks. Inflation is expected to peak around about September. What happens thereafter is going to be very important. So has the government got control of inflation? Does inflation drop off in particularly October time? If we see a drop of inflation in October, expect a rate cut around about November.
Okay, you have it on good authority. Peter says the Bank of England will probably cut in August. Let's hold him to it. Rejoice, first-time buyers, for you are saved. Yes, in July we had the announcement that we'd all been waiting for on absolute tentooks. Well, I was, Peter. Maybe you weren't. The government has decided to relaunch the mortgage guarantee scheme. It's had a bit of a rebrand, a bit of a tweak, but it's great news, Peter, because this is going to make it really easy for first-time buyers to borrow loads more, right?
No.
Okay, but Peter, work with me here. I need a little bit more than one word. I see the depth of your feeling here, but why is this not the solution to the first-time buyer crisis?
Well, I mean, if you look at the availability of 95% products, I mean, there was a huge availability of them. I think it was almost the largest amount of 95% products we've had available for the last sort of 10 years. 100% products were coming back into the market in reasonable force as well. Sure. So it was almost a solution in search of, or product in search of a solution, if that makes sense. So it really wasn't really necessary, I don't think.
Yeah, so anyone who wanted a 95% loan could probably got one anyway.
Yeah, exactly. So it wasn't like it was a product that wasn't really available out there.
The idea behind it is to encourage more lenders to offer 95% LTV loans. Do you think many lenders will actually do that?
They're already offering them anyway. I think that was the issue. So, if you go to your big 6 or your top 10 or your top 15, they're already offering 95% anyway. So, I mean, all it probably does is allow them, a little bit of them, to maybe transfer a little bit of the risk off their balance sheet by having a guarantee behind it. But
first-time buyers don't care about that.
No, so I don't think it's really going to make any difference to first-time buyers or really the pricing of the loans, because it's at a market rate.
Okay, what about affordability rules? We've seen some relaxation there. That makes it easier for first-time borrowers to borrow more. Is that the answer?
Well, I mean, it still comes back down to the problem of, it might help some more first-time buyers getting into the market. So, if you're getting declined at 4.5 times income and now you can borrow 5 times, that's great. But, you see some stories out there about first-time buyers now being able to, borrow 5.5 times income or even 6 times income. That might be great for the odd individual, but I do worry that, lending people, 5.5 times or even 6 times income is really not the solution, because, all we're doing is we're loading up first-time buyers with huge amounts of debt. There has to be a better way of doing this. I mean, ultimately, it's building more houses and, creating a sustainable housing market. Yeah. But there has to be a better way of making, mortgages more affordable for first-time buyers, and not just trying to kick off the merry-go-round of, encouraging more and more borrowing and more debt for first-time buyers.
Yeah. Well, the one thing that always does is just pump up house prices. Yeah. So you get more bubbles.
Yeah, if you allow more borrowing into a market which is very, very constrained, and you get a race to the bottom, which is house price increases. And as I showed in the last episode with the graph with London, and we can put it up again now. You're kind of looking at about 10 times income as an average in London at the moment.
And that is not sustainable.
It's not sustainable, and it's kind of why prices in London haven't really gone up, for the last sort of 4 or 5 years. It's really just a function of affordability. Ultimately.
I mean, they are falling now slightly, but clearly they're still way over the most ambitious mortgage multiples.
Exactly.
Yeah. Okay, so that's not the solution. Building houses, yes, everyone agrees that is the solution.
Yeah.
But is there anything else that can be done in terms of making it easier to borrow, get on that ladder?
I mean, help to buy worked to some extent. I mean, you need to look at the scheme as it was previously. I mean, obviously, some of the builders did very well out of it, particularly Persimmon, however I'm pronouncing that. Probably got that slightly wrong. And I think you need to look at the scope of it. So rather than just making it available for new build, you perhaps expand the scope of it and make it available for some, obviously, existing properties as well. So that would obviously help the builders, encourage them to build some homes where perhaps the value is a little bit constrained at the moment, because obviously builders are slightly reluctant to build where the property values are slightly going down, or is slightly undetermined. So that would help first-time buyers get into the market. So that's one option. And also, I think as a longer-term solution, we just need to look at how we just help first-time buyers and younger people generally. If you look at how the tax base is worked in the UK, and about the help we give people when they reach 60, free prescriptions, free transport, all that kind of thing.
It's great to be a boomer.
It's great to be a boomer. And then, the tax breaks and the tax benefits, triple lock, all that kind of thing. Why not look about, giving some sort of tax breaks to first-time buyers for a short period of time? Some sort of tax benefit or tax breaks to first-time buyers for 2 or 3 years when they buy a home. Just as an out there suggestion.
Yes, and so that would apply to the mortgage payments rather than things like stamp duty, because stamp duty, that clearly has an inflationary effect on house prices.
I mean, stamp duty needs reform as well. I think any industry expert knows that stamp duty is not a great help to first-time buyers. You know, as well as obviously affording monthly payments, you've got to find this additional upfront lump to pay, which is clearly, you know, not a great way to buy a house and a great cost for first-time buyers, an additional cost. So stamp duty clearly needs reform. If you talk to anybody, you know, who understands the housing market, that needs reform as well. But, you know, first-time buyers, if you're sort of challenging them to sort of need to borrow sort of 5.5 times income, you know, they're very, very constrained in terms of, you know, the first 2 or 3 years, particularly about monthly payments. If you can give them some sort of break on the monthly payments as well, you know, and look at, you know, how the whole tax system is biased and geared towards older people, redistribute that, you know, that would help. But that's pretty controversial.
Peter, we're perilously close to kind of pub territory here.
We are close to pub territory.
So I think let's put a pin in it there. Interesting to hear Peter talking about what more the Chancellor must do. Of course, it was one of their key election pledges, this return of the mortgage guarantee scheme. So I suppose kudos to the Chancellor for actually delivering that promise. It's still a bit vague at the moment. We wait to see the detail. But I think the message you're saying to the Chancellor is, well done, Rachel, must try harder.
Exactly. Needs to be something that's more substantive.
So we all kind of know what happens when the Bank of England makes a decision about the base rate. The 9 members of the Monetary Policy Committee meet and they decide what rate the base rate should be set at for the benefit of the economy. And it's one of the cornerstones of the Bank of England that it's independent from political interference. If you remember, Peter, back in the day, it used to be the Chancellor who set interest rates. And surprise, surprise, when the Chancellor was in charge of interest rates, election time, suddenly rates started to fall. People started to feel great, they had a bit more money in the bank, and lo and behold, the government got re-elected. Clearly that was not a good system, and it was Gordon Brown back in 1997 who scrapped that and made the Bank of England fully autonomous, and it is the Bank of England alone that sets the base rate. But how independent are central banks really? I think that's a good one for you, Peter, because there are people who are suggesting that the Chancellor, Rachel Reeves, is putting a bit of pressure on Andrew Bailey, the chairman of the Bank of England, over a few areas. Do you think there's any truth in that?
Yes, I mean, there's a bit of pressure coming on the FCA and PRA, particularly around regulation at the moment. So if you look at the housing market in particular, 15 to 18% of GDP in the UK comes through housing. So, you know, if we have a flat or, you know, declining housing market, it obviously affects the economy overall. So the Chancellor is very keen for there to be less regulation, very keen for there to be sort of growth in the housing market. And she's been very sort of vocal in saying that there needs to be less regulation or less strangulation of the economy where appropriate. So there's been pressure on the FCA and the PRA to focus on looking to get the economy growing. And there was a speech just on 15th of July at Mansion House basically saying they need to look at consumer duty again. So consumer duty is one of the sort of key underpinnings of the Financial Conduct Authority. So that's going to be looked at again. Obviously, at the moment, we're having the rules around affordability looked at. That's both obviously with the FCA and PRA. We obviously had the 15% affordability rule looked at. So there's pressure coming on both the Bank of England and the PRA in that regard.
This is more regulation we're talking about. So the Chancellor kind of throwing her weight around, leaning on regulators. There's no suggestion that she's putting pressure on the Bank of England to cut base rates faster than it wants to.
No, there's nothing on that side. I mean, we're seeing it very much on the other side of the pond.
Very different.
I mean, on the Fed, we're having, you know, Donald Trump calling Jerome Powell a loser,
a numbskull, threatening to fire him.
Yeah, I mean, lots of complimentary terms. I mean,
did you see that video of him showing up unannounced at the Federal Reserve building in Washington? He was giving it the kind of big man's kind of marching around, trying to intimidate Powell. They obviously hate each other.
I mean, bearing in mind that Donald Trump actually appointed Powell in his first term. I mean, you know, as we're kind of doing this, the US is in the process of looking at its interest rates again. They're going to be almost certainly held at 4.5%. That's going to annoy the hell out of Donald, which is going to be, personally quite funny.
So he might go from orange to red.
Exactly, it's going to just change colour again. Another deeper layer of tan. So obviously the US is worried about, or the Fed in the US is worried about the impact of tariffs. We've obviously agreed a 15% tariff with the EU now, and that's obviously going to be more imported inflation effectively.
So we've got clear pressure being applied
Yes.
on the chairman of the Federal Reserve, who's kind of the American equivalent of the governor of the Bank of England.
So
but here there's no suggestion that's happening.
It's not pressure on interest rates. It's pressure around regulation, which again has subtle implications around the impact on the economy. So it's pressure around regulation. It's pressure around trying to free up things and get the economy growing, and that again ultimately has an impact on the economy and rates in a more subtle variation.
Okay. Well, over to the Bank of England for its base rate decision at the start of August. We will watch that with interest, as I'm sure you will. We should say that this is your show as much as ours, and we love it when you send us questions. And now would be a good time to do that, because for the next edition of The Rate Stuff, we're going to have an actual expert on the show, Peter. Yeah,
really? Somebody knows what they're talking about.
Yeah.
Wow.
He's going to sit here, so you're probably going to have to budge up a little bit.
Okay.
But you need to make room for this guy, because it's Matthew Cumber, who's the managing director of one of the leading surveyors in Britain, Countrywide. Yep. He is a pro on all things house prices, property market. So any questions you have about that, do send them our way. Make sure you give the show a like or a follow. We couldn't do it without you, but it's been great to have your company today. I'm Jack Izzard.
And I'm Peter Stimson.
And you've been watching The Rate Stuff.